Okay, students, so let's understand the export procedure. Now, export procedure is quite similar to the import procedure. Let's see what other points are given in the export procedure. So, when a trader of a country sends goods to a trader of other country, it is said that he has exported goods. And export procedure is different in different countries. So, let's see the export procedure of India. First is getting an order. So here the exporter is being given the orders by the importer, and in order all the details related to goods, quantity, price, type of packing, date of dispatch of goods, then details of insurance, detail of transportation services through which the goods have to be sent, and mode of payment of bill, and the terms and conditions are clearly mentioned in that order. Now, before receiving the order, the exporter also gets the information of the importer related to its financial capabilities, what is the credibility of this particular importer in the market, and relevant matters to the importer. So, if it is safe to do the trading with the particular importer or not, so that kind of information the exporter try to get before placing and before getting an order. Now, the number 2 is obtaining export license. The exporter has to obtain an export license in order to export the goods which come under the import export control laws. The other items apart from this can be freely exported, but for this a general license has to be obtained. Now, exporter has to obtain a general license if the list of the goods, if the goods is not present in the list of the goods. Now, to obtain this license, the exporter has to give an application, and in the prescribed form to the trade department of the government, and it is necessary to give the clear identity of the exporter and details of the exporter and assurance of the regular payment of income tax and other taxes in the application. So those professionals who are export regularly are called export house. Now, the number 3 is collecting goods. The exporter collects the goods as per the importer's order after obtaining the export license. If the exporter is the manufacturer, he starts manufacturing the goods as per the order, and if the exporter is a trader, he starts collecting the goods as per the order. Now, the next one is the foreign exchange activity. Now, many controls related to foreign exchange have been liberalized after the economic reform of the 1991, that is LPG, liberalization, privatization, and globalization. So, the importers make payment to the exporters amount of bill either in the exporter currency or in the US dollar. So the Reserve Bank and its appointed bank and institution keep control over foreign exchange. Therefore, exporter has to make an application to the Reserve Bank of India with a view to convert the foreign exchange received from the importer to the currency of his country. For example, if the exporter is from India and he is exporting the goods to another country, so whatever the payment importer is make, that will be in Indian currency or in the US dollar. Now, if he is making the payment in the US dollar, so the exporter has to go to the bank for the foreign exchange to convert that US dollar into the Indian currency. So for that he need to write an application to the Reserve Bank of India. Then exporter has to provide the complete details in the application form to the Reserve Bank of India regarding how much foreign exchange he is going to earn. So the exporter has to submit a copy of this application to the bank or through institution which he makes the transaction. The fifth point is obtaining a letter of credit. The exporter checks the financial capability of the importer before exporting the goods for the securities of the amount of his bill, for which the exporter writes a letter to the importer to demand a letter of credit from his bank. Sometimes the bank of the exporter assigns this task to its own branch working in the foreign countries or get it through the sources. The exporter, the certificate of credit of the importer mentioning that credibility of the importer is reliable This is known as a letter of credit. So in the import procedure, we learn that the importer is getting a letter of credit from the bank, which shows that, or which gives an assurance to the exporter that the credibility or the financial stability of the exporter is quite reliable or is quite strong. So on the basis of that letter of credit, the exporter can send his goods to the importer. So the importer is getting that letter of credit for the assurance of his credibility. Then the sixth point is obtaining a shipping order. The exporter has to contact a shipping company if the goods are to be exported through a seaway. An application is made to the company which assures about readiness to reach the goods on certain date. The details of the goods, such as the quantity, weight, size, the date of sending the goods, the price, etc., are mentioned in this application. In short, the shipping order means order issued to the captain of the ship by the shipping company to accept the goods. In case when the exporter wants to export the goods in large quantity and wants to book the whole ship, it is called a charter. The agreement between the shipping company and the exporter to keep the whole ship on the rent is called charter party agreement. Next is a payment of excise duty. Now each exporter has to pay the duty. Exporter has to obtain the certificate from the duty officer if the duty is not to be paid. Then a prescribed form containing a public notification certifying that the goods is duty free. If the goods are excisable, the exporter has to prepare a shipping bill in which the details like the name of the importer, address, price of the goods, quantity, weight, the name of the port where the goods is to be boarded, the name of the ship and shipping company, etc. should be described. The excise officer calculates the duty on the basis of the price of the goods, quantity, etc. The excise officer determines the amount of duty after checking the shipping bill and inspecting the goods by himself. If necessary, when the exporter pays the amount of the excise duty, he gets the permission to carry the goods on the port. Now, after getting this payment of excise duty, packing and marking of goods is there. So packing is very important in international trade. The goods to be transported for a long distance, therefore it should be packed in such a way that it does not get damaged due to the transportation or due to humidity in the atmosphere. Sometimes the shipping company also consider the size of packing while determining the fare. The packing must be done as per the packing instructions mentioned by the importer in the order. Marking of some important details related to the goods on the packing is also necessary. So details like the name and the address of the importer and exporter, the name of the destination port, weight of the goods, etc. are mentioned in the marking. Then number 9 is getting insurance of the goods. So in order to protect the goods against the possible risk like a cyclone, damage the goods due to weather, then due to pirates, etc., the goods has to be insured to get the economic return. To get the economic return, especially is to be transported through the seaway. So an agreement is made between the insurance company and the exporter. Now exporter obtains the cover note after paying the premium to the insurance company. The insurance company issue the policy against the cover note. Next is obtaining carting order. So carting order means permission of boarding goods on the ship. Exporter gets the permission that he can load the goods on the ship is called the carting order. The exporter has to make an application to the port authority from where the goods are to be exported in order to obtain the carting order. So to get this carting order, exporter has to write an application to the port authority, and in this application he has to mention all the details of shipping bill along with the details of the payment of excise duty. Then exporter also pay the port expenses like charge of transfer of goods and charge of boarding the goods on the ship. He obtains the carting order. Next comes the mate receipt. Now when the goods is boarded on the ship on the basis of the carting order, the representative of the captain of the ship is known as mate. So the captain of the ship is called mate, and that mate checks the goods whether it is as per the shipping bill or not. Or when the goods is loaded on the ship, a receipt is issued by the captain or by his representatives for the acceptance of the goods. That receipt is called, or that acceptance of the goods document is called made receipt. The captain of the ships check the packing of the goods. If the captains find the packing of the goods improper and it is not suitable for transportation, that it is marked in the receipt, and such marked receipt is known as foul receipt. That marked receipt is known as foul receipt. If all the matters are proper, means all the packing are proper and everything, so he gives a clean sheet. He gives a clean sheet. And if mate's receipt is foul, it means that goods have been loaded on the ship are not properly packed as specified in the order. And if the goods are damaged during the transportation, the shipping company is not responsible for that. That's why mate or captain checks the goods as per the shipping bill. Then obtaining the bill of lading is the next step. Then mate receipt is the receipt of goods loaded on the ship, but it is not an agreement that goods will be transported. So bill of lading is a document or is an agreement of transporting the goods. So exporter obtains that bill of lading from the shipping company after producing the mate receipt to the shipping company. So bill of lading is an agreement between the shipping company and the exporter, that whichever the shipping company gives the assurance to the exporter to transport the goods from one port to another. And in that also details of exporter, name of the ship, freight, details of the goods, quantity of the goods, price, weight, name of exporting port, terms and condition of the transportation are described clearly. Then the next is certificate of origin. The certificate describing the details where the goods were produced is called the certificate of origin. And according to this agreement made by according to this agreement made by different countries, respected countries provide relief on import excise. Now move to the consular invoice. When the exported goods reaches in the country of the importer, excise on that goods has to be has excise on that goods has to be paid. So the exporter obtains a certificate about the price of the goods from the consular is called consular invoice. Now the next one is sending documents. So exporters send the important documents to the importer, like invoice, insurance policy or cover note or bill of lading, then certificate of origin, consular invoice, bill of exchange, etc. to the importers through bank. Now, collection of money. The exporter gives the advice to the bank for the collection of money. The exporter writes bills of exchange to the importer in order to collect the amount mentioned in the invoice. Now, this bill of exchange may be DA, that is a document against acceptance, or document against payment. In document against acceptance, the bank of the exporter present the bill of exchange to the importer. He simply gives the bill to the importer and bank release the documents of the goods, and he gives all the documents of the goods to the importer once the bill of exchange is accepted by the importer. But if it is DP, that is the document of payment, so at that time bank gives the documents only after the full payment is done by the importer. After paying all the amount, the bank gives all the documents related to the goods. Now bank collects the money as per the maturity date of the bill of exchange. Whatever the date is mentioned in the bill of exchange, according to that bill collects the money.